Bilal Hafeez, Macro Hive founder and CEO, joining me now to address this very question. Bilal, what do you think that means? Where do you think the market is going next? And what do you think the administration would really like to see?
No, that's all kind of good and valid points. I think when Treasury Secretary Yellen talks about market-based exchange rate, that's almost like a boilerplate comment that she almost has to make. Essentially, she's saying we're going to allow the market to determine the level of the dollar. We won't do currency intervention. It also could be a nod, though, to emerging markets to tell them that, look, you can't intervene to weaken your currencies. As we know, many countries, particularly in Asia, have been intervening to slow down the appreciation of their currency. So it could be, you could interpret it in that way. Now, as for what the administration wants, I would think that they ideally would want a weaker dollar, because almost every country does want a weak currency. They want to, in the case of the US, they definitely want to improve their trade balance, reduce their current account deficit. They want inflation as well, and a weak currency is a very good way to achieve that. And then as for investors, as you asked, I think it's more of a mixed bag, as you alluded to, Guy. At the start of the year, people were generally quite bearish on the dollar, but since the rise in US yields, I think people have become a lot more cautious about further dollar weakness from here.
People are trying to figure out what the relationship between what happens with the dollar is and the US economy, and whether there's a strong connection there at the moment, and whether or not the bounce back that is being priced in the bond market, the reflation trade that we're seeing with yields rising, is going to be something that is sustainable. What is your view on whether or not the recent reflation bounce that has taken the US 10-year to around 1.1% has got more to give?
Well, my sense, first of all, is I think the rise in yield reflects a potential fiscal stimulus. It's as soon as the Democrats won the Senate that we saw this jump in yields, which means that it'll be much easier for the Democrats to pass the fiscal stimulus, which in turn, means a boost to US growth, which means higher US yields. What I don't think it means is that the Fed will taper anytime soon. So there has been a lot of speculation that the Fed will taper. But I think comments from Clarida, Powell have all told us that, they're going to delay tapering. They've got a new inflation targeting regime, so that's further away. So as a result, even if we do see stronger growth and even if we do see higher US yields, I don't think that will be enough to really support the dollar very significantly.
What about the impact of high yields on equity markets? People are concerned about whether or not current valuations can be justified, and if so, for how long do these equity markets continue to rise? What will upset that trade? Could it be higher yields? Could it be something else?
No, that's a good question. I mean, my sense is if yields are rising because of fiscal stimulus or reflation and not because the Fed's going to raise rates, then I think that's an environment where equities could continue to go up. So in that context, which I think is a context we're in at the moment, I think that's still constructive for US equities and global equities in general. I think where it gets more problematic is if the Fed does start to get concerned about inflation pressures, which then the market has to contend with, which could start to impact equities, which I think we're quite far away from as it happens. The other side, I think that could impact equities is some kind of escalation of tension between the US and China. We're starting to speculate a lot more about what the Biden administration wants to do with China. If it is something aggressive, that could negatively impact equity markets, including in the US. And then also the third thing that many of the clients we speak to at Macro Hive is that people are starting to get a bit worried about the variant of COVID that we're seeing. The second waves, third waves are much more aggressive than people had thought, and so that could suppress activity for longer than people thought. And so that could be perhaps the biggest factor that could see a weaker equity market.
Bilal, you were talking just a moment ago about the concern that investors increasingly have that the new variants are going to be meaning that lockdowns last significantly longer. We've got the ECB on Thursday, and President Lagarde said a couple of days back that she still feels that the staff projections are still reasonable. Do you think actually that a lot of economists, particularly at central banks, are underestimating the impact that these longer lockdowns are going to have?
Yes, I think they are. So I mean, nobody was really expecting this sort of second variant to emerge as it has, and for it to spread across Europe and the rest of the world in the way it has. So I think people are underestimating the impact in the near term. But I do think that the broad contours of people's projections, of the ECB's projections, of first half weakness, second half strength, is probably still the right view to have. So in that sense, that outlook or the profile hasn't really changed a huge amount. But what it does mean is we'll have bigger near-term weakness in the first half of this year. And from a structural perspective, the issue here is that the longer you have these prolonged periods of weakness, you then have a higher chance of structural unemployment and structural weakness, which becomes much harder for policymakers to deal with going forward.
Bilal, Europe has largely pulled together during this crisis, but we're starting to see cracks emerging, both domestically and also at a European level. Europe, it seems, or the EU, the Commission, has not been great at vaccine distribution. That's causing quite a lot of concern. And then we're starting to see cracks emerge politically in places like Italy. As we come out of this crisis, and this is why I asked the question to Chad, I'm wondering whether or not we can expect more political turbulence in Europe. Once people start to get their freedom back a little bit and start to point fingers at the way that politicians have handled the crisis, I wonder if we should be pricing in more political risk.
Yeah, I certainly do think we will see more political turbulence as this crisis evolves or it start to subside. I mean, there's the obvious one, particularly in countries like Germany and some of the so-called frugal four countries, is when and how aggressively to scale back fiscal stimulus. Once the pandemic eases. So that's kind of one thing on the hawkish side that we'll start to see more conflict over. The other one is the vaccine policy of the EU, because certainly it seems like the EU has been slow and has impeded vaccine distribution in some ways across the European countries. And so there will be some kind of reaction around whose fault was that. So an example will be in Germany. Germany seems to have subsumed its own interest in favor of a European-wide vaccination. So Germany could have had more vaccines for itself if it followed a national approach and decided not to. So that could be something that could come back to haunt the CDU and Merkel, going forward. So there's lots of different kind of areas of tension here, and I imagine we will see more of that going forward.
One of the other things that could emerge from this as well is how Europe views China, and having just signed not a trade deal but a cooperation deal with China, I'm wondering whether or not that could face headwinds. The Biden administration is likely to want to take a very different approach to China, and I'm wondering whether or not the EU is going to have to revisit its approach to China, particularly with the departure of Angela Merkel.
No, that's a very good point. And this will, I think, be an ongoing tension between the EU and the US. And in Germany in particular, hasn't really shown any signs of wanting to cause any trouble with China. Merkel, as you've rightly pointed out, has promoted, cooperation between the two blocs. And if you do look at the potential replacements to her, as you mentioned earlier, Laschet or Söder, both of them seem also to follow Merkel's viewpoint in terms of having a favorable or very trade-centric approach to policy, which in turn would mean being very supportive of relations with China. So this will be a big point of tension between the EU and the US. The one kind of wildcard here, which is different from the Trump administration, is that Biden will have more of an active climate change policy. And so that could be an area where there could be more scope for compromise with China and the EU, where in return for some agreements of climate change, the Biden administration may allow certain things to happen on the trade side. So that could be something that could sort of pan out to be less hawkish on that side.
Interesting stuff. Bilal, always a pleasure. Thank you very much indeed. Bilal Hafeez, Macro Hive founder and CEO.